Cool. Thank you, Lucas. Great session. Pleased today to be joined by people that have come a long way. Ernesto from Madrid. Thankfully, the seats aren't too comfortable. Yeah. You can stay awake.
Yeah. Hopefully, I just grab a Coke.
Good. Henry, all the way from Melbourne. Hopefully, the coffee was good enough for you up here. So, as an intro, not everyone in the room knows you well. Little intro to yourself, your business, and what your differentiators are for Transurban and Ferrovial. Start with you, Henry.
Yeah, well, I think people will be broadly familiar with the parameters of our business. So we're Australia's largest toll road operator, 21 concessions across 5 markets, Australia and North America. These are sort of broad boundaries. But when we think about competitive advantage in the business, you could probably look straight to our strategy statement. By understanding what matters to our stakeholders, we create road transport solutions. It makes us a partner of choice. Strategy, you've got to be careful with strategy statements because they can be a little trite at times. But we put an enormous amount of thought and effort into that. Some of you will have seen we reformulated it about 12 months ago. And there was a lot of debate. Scott, myself, and a bunch of others around the table went into the business. So the 3 components of that it talks to, if you think about it, the first is stakeholders. By understanding what matters to stakeholders, you'll see a lot of the way we talk, we frame it up in terms of the stakeholder groups. It's not just governments, it's not just investors. We've got communities in there. We've got industry partners in there, so employees as well. So there's a broader sort of framing of that, and that's an important context factor in terms of then the prism through which we look at the world and how we manage the business. The second piece is around road transport solutions. So we've unambiguously pointed the business towards roads. We know that's our trade. We have, through the course of the journey, looked at other asset classes and wondered whether there wasn't an application of our skill sets there, but we've tested it. And the statement tells you that we've answered it. But we're focused into roads, and that's where we'll play. And then the third piece is, if we're successful in doing that well, we get into a partnering arrangement where we can then co-design and we can start to really apply the differentiation of the business. So again, partnering isn't just governments. Partnering is increasingly industry partners, particularly when we think about innovation and where that's going and the application of technology on the networks. But again, it becomes a central piece in what's driving the success of the business.
Cool. Thank you. Ernesto.
Well, thanks. Well, actually, we have some similarities with your business. I mean, the main difference probably is that we have the whole value chain, so we engage in construction, and we seek opportunities and generate with reverse inquiries the opportunity, right? And usually we look for congested areas where there's not much room for infrastructure, and we try to design things that are more sustainable, so less impact from structures, but something that could sort a congested area and also minimizing public money, right? So that's kind of our proposition. More in toll roads, I think that is a business that is quite resilient even in bad times and also keeps growing a lot. But we also do airports, and in airports we also tend to go for airports that are have a commanding market share, right? So I mean, Heathrow in London or JFK in New York, and there we try to also build on the complexity to operate an airport, right? So doing construction in an airport is very complicated. So if there's an overhaul, we could have an angle, and then of course to try to do excellent operations. So that's our main business.
Good. We're going to talk about construction and particularly interested in how you're doing JFK while it's still operating. So one of the things that's most unique about both of your companies is pricing power. It's the ability to increase prices at or above inflation. Inflation is obviously very high around the world, and I guess one of the challenges, and speaking to the bear point that was raised earlier, the cost of living crisis that everybody's dealing with. So as a shareholder, I want you to maximise price, maximise inflation. On the other hand, you've got a social licence to operate. So I'm interested in how you balance those things out. I'll start with Ernesto.
Okay, that's a very good question. And actually, we kind of provide a choice, right? So it's not like you have a monopoly and then you're squeezing people, right? So when we build these roads, usually you have free lanes, you're adding capacity to the corridor, right? So, I mean, you're providing a choice. And then, of course, you are there to optimize revenues, but usually you do that a long time, not really going to the maximum price possible very early, but you try to optimize revenues. Of course, that wouldn't work if people didn't like the product. So for us, the best proof is that our public clients want repeat business all the time because their voters, initially, they are against tolls, but then after things are in operation, they think they get a good service. So good quality, the best price we could achieve.
I liked your story this morning of the new name for your lanes. Did you want to share that?
Well, it was a public client that wanted to sell it to his voters, and he said, we're going to call them choice lanes, not managed lanes. And I think we should change the name to all our portfolio, right? The right choice, the best choice lanes.
You haven't trademarked that, obviously. So
That'd go down really well in New Zealand. Choice grow. in the lanes. 407, we're going to get a toll increase this year.
I mean, I wouldn't be giving any information here that I couldn't give to the broader public, so good attempt.
Next year, then. Henry.
Yeah, well, I think your question goes to the sort of social license risk factors around the business, which we're obviously all pretty focused in on. And the short answer is price is not the way to address that in our sector. We learned that lesson through COVID. So COVID brought more acute financial hardship through our customer base than we'd ever seen. And then if you think about the practicality of what it would have meant to start playing with the pricing mechanisms, which obviously have a significant compact with our capital in terms of the expectations in the financial markets, and what it would have delivered the people in financial hardship, there's a total disconnect. A quarterly toll price increase on CityLink might be worth between 1 and 10 cents a trip. 10 cents being the maximum for someone who's doing the full whack. So someone would literally have to be travelling hundreds of times to save tens of dollars on it. It doesn't address the issue for someone who is actually really burning. So where we went to was, and the business is much better for this. I think we've unambiguously strengthened our proposition here, but we've developed very honed hardship programs that identify customers in hardship, give them real financial support. So hundreds of dollars. In the case of COVID, people were getting hundreds of dollars of toll relief if they're at the acute end of the hardship spectrum. And we've since kind of maintained that to some extent. So, it was tens of millions of dollars that were given away in free tolls during COVID. That's obviously come back now as the hardship elements have relieved a little bit. But we have an elevated allocation towards that, understanding that it's an issue that needs to be managed. So then we're addressing hardship properly, and we're not playing with the compact of the market, which we think is incredibly important. I think the other thing you'll see is over time, we start doing things further down the spectrum of hardship. It won't be the kind of significant toll relief I'm describing there, but it will be systems that are more capable of working with the customer base to get them on payment plans and things like that. And you're seeing that in our latest technology upgrades as well. So the sector's responded, but it doesn't sort of go, there's a knee-jerk reaction to go to the pricing mechanisms, and it's the wrong place to look.
Yeah. No, I certainly agreed with that. Response during COVID is maximise the tolls and look after customers that really need it. And I guess technology and data allows you to segment your customer base a lot more than perhaps you were able to do 5 or 10 years ago.
Yeah, and we look at our customer segments very closely in this respect. So we know that, and Hannah will be able to give everyone all the detail on this, but 80% of our customers spend less than $10 a week. We know where we sit in the basket of goods for household expenditure, and we're well down the list of things that come up in terms of concerns during cost of living sort of periods. Mortgages, groceries are well above where you would think about in terms of where tolls come in. So it's something we monitor just to make sure we're not drinking our own Kool-Aid and missing something.
Cool. Let's switch to traffic. So COVID, unprecedented impact on traffic patterns around the world, something we hadn't seen since World War II. But certainly coming out the other side, and we've seen a recovery across the board. But are there any structural changes in traffic that you've seen across your networks and airports and toll roads, Ernesto?
Well, I mean, there's been changes. Work from home, of course, is more present than it was before. It was already there. So probably you have more flexibility, and that is affecting weekly patterns. I mean, usually Mondays and Fridays are softer than the middle of the week. And also you have different patterns for people that stay at home. I mean, they tend to make trips in the afternoon for different reasons, right? Be leisure, I don't know, cultural, whatever. So medical appointments. So kind of the morning is a little bit more for commercial traffic. People that go to the office pretty much go the same hours. It's not that they have changed their patterns of when they get in or out. And also, one of the things that we've seen is more city sprawl. So people that were living in apartments, I mean, also have tend to move away. So you have more people living in suburbs than what we had before. So that also has changed a little bit patterns, but overall mobility, except for certain cities, is not much different in total, right? So maybe it's less concentrated, but the mobility is very similar.
Yeah, I totally agree with that point, and that's the starting point when you're thinking about these overall volumes on the network are getting back to above pre-COVID. We've seen it on our network. So Sydney and Brisbane in our portfolio are trading above pre-COVID levels and growing well. Melbourne's still got a little way to get there, but not much. And we're still seeing a recovery, which is probably a really important point, because there was a question mark out there, I sensed, in some quarters about whether the structural changes had created a new kind of cap, for instance, that we were then going to. We're not seeing evidence of that. We're seeing continued recovery. It's just taking a little bit more time, particularly in Melbourne. In terms of them profile, yeah, we have seen some changes in profile. So the peaks are probably getting back to their levels where they were in terms of the absolute levels, but the kind of profile of the day looks a little bit different. The peaks aren't quite as wide as they were. But again, that's probably just something reflecting the kind of recovery curve that we're on. And I think we'd expect them to ultimately get back to approximate what we saw pre-COVID. The thematics around work from home, we all know that has shifted a bit, but it's not translating into fundamentally different volumes on the network. It probably, as Ernesto said, just means that people are configuring their days slightly differently, but they're still moving about the cities. And then obviously the big thing that everyone's watching is return to the CBD and the office occupancy. And I'm sure everyone's reading the same stuff I am there, but it's still a little ways off, but it does appear to be recovering.
Cool. Yeah, I mean, Friday afternoon used to be the peak. I guess Thursday is the new Friday now.
Yeah.
People working hard, drinking on Thursday, and then working from home on Friday.
And discretionary travel, the weekends are stronger, amazingly. So there's been, you might be seeing it as well. Saturday's stronger than Mondays.
Saturday stronger. Wow. Okay. Good. So let's change tack and talk about construction. These are complicated.
That's what Henry, right?
These are complicated projects, right? You're digging through contaminated soil, through mountain tops, middle of interstates, above railroad lines. A lot of things can go wrong, and I guess you've taken different approaches to construction, and I'd be interested in how you're keeping projects on time, on budget, with your different approaches. I'll start with Ernesto.
Yeah, I mean, you're absolutely right. I mean, construction is tough, in particular when you have all these big projects that have a lot of design that at the time of bidding, maybe they are not final. So it's quite tough to get firm prices right away. And then, of course, I mean, the inflation running away means that some people just struggle to comply with their contracts, right? So, but what's the way around that? I mean, work a lot in advance so that when you bid, you are pretty much close to final. And then now there's more of a combination of own resources. I mean, in the past, we used to subcontract everything. Now you need to have more of your own resources and probably stay more in areas where you know that you're going to do repeat business. Otherwise, just subcontractors can kill you, right? So it's tough, but it's worth it for the quality of assets you can get. So, I mean, the main drivers, I mean, value and risk, try to avoid them, but always keep in perspective that it pays, and it pays for the client to see a good delivery, right? So it's about delivery and risk management.
Thank you.
Yeah, and as Ernesto said, we're slightly different in terms of how we configured as a business. I think there were some questions around whether that would change in light of the well-publicised issues we had around Westgate Tunnel, and the answer I think is no, with the caveat that we have obviously learned some lessons from that. So there's clearly some more, a little bit more pre-work that's going on around risk allocation now to sort of understand that better. That's things like, the obvious things, soil testing, a little bit more work around the kind of design build sort of pre-work that you would do just to get a better handle on risk. But the corollary to that is that then we cover any risk in contingency when we're factoring it in, so the project economics don't change. I think more broadly, we would say that when we look forward, we as a business, and this is probably more by happenstance than design, we have the least risk that we've had in many years in this sense in terms of what our project pipeline looks like. So, now we've delivered all the bulky parts of the pipeline, all the tunnels, with the exception of Westgate, are now kind of up and operational in terms of the ones we had in the pipe. We got a lot of surface work. All the remaining projects are smaller surface works, and the sort of capex quantum of our pipeline would be the smallest as a percentage of our sort of enterprise size that it's been in. Peter, you'll probably know better than I, but it would probably be a decade, I'd say.
Very good. Yeah, good to see Westgate 90% tunnelled, give or take.
Yeah, we're close. We had the breakthrough in one of the directions recently, which I'm sure many saw, and it's going well, is the short answer. So obviously we did have some challenges. I was involved in the kind of team getting that one back on track, but it is back on track now. And
how much PFAS?
Very little PFAS, but that was not so much the point, albeit I can understand why that sticks in people's throats a little bit when you say it. But the issue was more around the kind of regulatory environment of what we had to do in the event that PFAS emerged. So it was a contingency that we had to manage, and the laws changed around it, which meant the whole sort of process around the disposal of spoil on the project was upended. So that's the issue that we were dealing with. But I'll start rocking if we keep talking about this for too long.
Light at the end of the tunnel. Ernesto, I want to go back to JFK. I just think it's such a fascinating project. The scale of it, how busy that airport is, trying to do construction while it's operational. Any colour or insights you can share with the room on how you're managing that project?
I would try to keep it simple, just by saying no to much of the change orders that the Port Authority or the airlines want to do. So you're right, it's so complex, and now that airlines are trying to get an early land grab, let's say, for VIP lounges or stuff, that they are for many things that really have to be paid by other airlines coming in, right? So you need to stick to the design probably that you have in place in the beginning, and not just do a little bit of what makes sense. The Port Authority knows that, airlines know that. So it's a lot of refusing things, and then of course a lot of early procurement. It's better to have some stockpiling than risk inflation going out, right? But really, we are not doing the construction. There is the PMO, and we think that the contractor there is very professional, Tishman. They've been doing things in New York for ages. So, cautiously optimistic that we should get it done in good shape.
Good. Look forward to that. The construction projects, there a lot of capital required, a lot of concrete, a lot of carbon comes with that. The operations themselves, whether you're looking at scope 2 or 3 or 4 customer emissions, what are both your companies doing in terms of trying to minimise, carbon impact or carbon emissions from both you and your contractors and your customers?
Okay, so well, first of all, we try to bring designs that minimize the need of concrete or cement, and then recycle as much as possible. And a lot of that goes on in the design. With how you use earthworks, right? Trying to have a neutral impact from earthworks, and as I said, recycling from crushed concrete or things like that. So very rarely we go below 70% recycling. And of course, we also try to make it economical, right? And combine a solution that is economical and with less of an impact. Not all the regions in the world are so focused on that, but as long as the economics are right, combined with the rest, that's the best solution. So minimize with design and recycling all the impact.
Yeah, and I think we've got a better story to tell than people think in this space when they look at it at first blush. I mean, our profile is about 100,000 tonnes a year of scope 1 and 2, about 400,000 tonnes of scope 3, and then 1.2 million tonnes of customer emissions across our business. So the targets that we have that we agree through the Science Based Target Initiative are only scope 1, 2 and 3. The customer emissions are excluded from that. We don't exclude on that, so we report on those, and we think about those a lot in terms of what we have to do there over the medium to longer term, because we recognise that regardless of whether they're in our targets, they're in the court of public opinion. So we do think about that a lot. But scope 1, 2 and 3, we've made really good progress on. So I think scope 1 and 2 are about 200,000 tonnes 2 years ago. So I think we brought that down by about half, and that's obvious things like power purchase agreements, moving to renewable energy. We're about 80% renewable in Australian markets now. Scope 3 is a little harder because you're getting into the supply chain. So that's working with coalitions to find ways to use smarter materials. In particular, materials are a big part of that. And we're having some success. So I think we've already seen some reduction in our recent projects in the order of 20% in recent years. So we've got measures to bring it down. In terms of the carbon intensity in our builds by 55% by 2030. That's agreed. And we're on track to hit those. But there's a broader kind of network effect that we've got to play into there to hit that. Yeah, so look, I think, and then over longer term, we're going to see vehicle fleets, I think, transition in a way that helps us with the customer emissions. As it stands at the moment, we already provide a benefit to the free routes in terms of carbon savings. So it's not something that you necessarily always want to trumpet because people can take issue with it. But the reality is that to travel on our roads compared to the direct competing route, you're saving somewhere between 20 and 30% carbon already. But the real task will be how do we bring the 1.2 million tonnes or whatever that is in the future off an expanded portfolio down. And there'll be a natural tailwind from vehicle fleets. And then the question is, what can we do to accelerate that, which we're working on.
I like the app where you do the time saving, but then also the fuel saving and the reduced carbon emissions, and telling that holistic story can help people make the right decision to be on a toll road.
Yeah, and there's always a right reason. The reality is it doesn't get into enough people's hands at the moment. That's a trip compare tool that we developed a couple of years ago. And it's probably more a marginal curiosity for people at the moment. I wouldn't say that all of our 5 million customers in Australia are looking at that every day, sort of marvelling at their carbon savings. But over time, and this, again, it'll probably tie into the conversation we have on innovation down the track, but as we get more into the vehicle and or others, it might not be us, there'll be ways in which we can communicate this more effectively, and it will just strengthen the perception of the value proposition of the business.
And Rob will probably correct me, but I think you actually made money from the renewable PPA last year.
We did, yes.
Yeah, so good one. I'm going to ask one more question, and then I'm going to open it up to the room. So think about what you're going to ask, make it interactive. Next question from me is around the US strategy. You've both had wonderful success stories, I think, in Texas and Virginia, and those assets are performing exceptionally well, even COVID impacted. But, I guess beyond those states, there's more of a challenge, and obviously Maryland's been a challenge more recently. Because how do you extrapolate that success in Texas and Virginia and convince other states in the US to get on board, Ernesto?
Well, I guess that it's a two-pronged approach. Right? I mean, one of them is when people are facing a problem of real congestion, come with a solution that requires little public money, as we mentioned, and then of course have all the information from customers in other states how satisfied they are, And that kind of image that you get from Dallas Fort Worth, from Virginia, from areas that people are really satisfied, works well. So other states are considering that, and maybe we are close to 8, 9 states looking at those things. Not that much, but every single project of this is quite huge, right? So I mean, we're looking forward to all the opportunities, and then they're motoring up.
Does it matter, Republican, Democrats, or you think there's opportunity?
That's for me as well.
Yeah,
I thought that the politicals were for
yeah.
no. Okay, so it's more Republican, but we have some Democrats now that want repeat business. So once they try it, they always repeat.
Yeah, I mean, it's our view is probably not dissimilar in a way. We're certainly not looking at 8 or 9 markets in the US at the moment, but we do see it as a market of opportunity, unambiguously still, and a growth market for us over time. The Virginia base is a terrific base, and we've had a lot of success there. But if you look at the amount of time it's taken for us to develop that in of itself tells you about the challenges of trying to develop these networks in the US, that it just takes time. It takes a lot more time to bring a project from woe to go than it does, say, for instance, in Australia. And then the reasons for that were on show recently with Maryland, which I'm sure everyone saw the commentary around that. We ran into challenges around environmental approvals in particular. The change in the political landscape didn't help it, but ultimately we just couldn't see a way through, and we're not going to persevere with a project that doesn't make sense with us. So that's why we walked away from it. But walking away from the project doesn't mean we've walked away from the market. The market's still there and we still see opportunity, but again, it would have to make sense. And I think people should expect that it's going to take time, because it doesn't. History shows that projects don't move quickly there by virtue of just the processes that sit around them and the hurdles you have to clear.
It's not unfair to say you would spend tens of millions of dollars bidding on these projects.
It's not unfair.
Yeah, big investment. All right, who's going? Right.
First question.
Hang on, Mike.
First question for you, Henry, on Maryland. When you think of the reputational damage for walking away from a project that you had with the Maryland government, how do you think about that? And then what do you gain, notwithstanding the fact that you want a return on capital for every project you work on, but what do you gain from a structural point of view from walking away from a project which had some, issues with it? Does it lend itself to better projects in the future?
Well, clearly it's not an ideal situation, Mark, and I don't think we pretend it was. But equally, I think the supposition behind your question was that we had a choice, in that that we had a choice to stay around and pursue it or not, and we didn't in our eyes, because there were deadlines involved, so time frames had expired and there was no way through. That's the reality of why that particular situation manifested. And then the reality is, and I would expect most of our investors would support this, we're just not going to do a deal that doesn't make sense. We're not going to pursue something that we think could ultimately not work. Now, in this instance, the issue was that it was just very opaque because of the environmental challenges. People will have seen in that market challenges in another asset class around the purple line, which had similar issues. And so when you added all that up and the team added that up, that was really the only choice we had in front of us. But it was project specific. And then the question, when it comes to how we manage it, turns to the skill of the team in the market, working with the government partners so that they understand the context and the circumstance, and the strength of our relationships becomes very important at that point. And that's obviously what's been going on.
Don't be shy. Chess. This is not a Dorothy Dixer.
So I'm fairly sure that I know how Henry will answer this question. So I'll direct this towards Ernesto and to Peter. Valuation aside, which I know is not the world we operate in, but humour me, would you prefer an airport or a toll road asset, and why?
Okay. it all depends, right? Because it depends on the pricing power you could have. So usually an airport, if you have pricing power, you're going to be regulated. So odds are that I would choose a toll road rather than an airport, but it has to be case by case. And for instance, in JFK, we like the fact that there's more demand than capacity available, and we have flexibility in pricing, right? So not bad. But otherwise, I mean, toll roads in an urban area are very difficult to compete with anything, right? I mean, if capacity is scarce. So in general, odds are for toll roads, but some airport opportunities could be better.
Yeah, thanks. As you know, Jess, we don't love or hate any stock. They're just problems to solve. But a toll road every day of the week would be my say. 75-year concession, inflation-linked tolls, low country risk. You know, a corridor that leads to a high growth region. You'd buy that every day of the week. Airports, you know, I guess have event risks which you need to be aware of, and often have capacity constraints because, you know, depending on the air traffic surrounding, and you know, they can, you know, I guess shift more towards real estate, you know, for half the business as well. So keep it core and keep it toll roads.
Could be our new strap line.
Rob, I was going to say, if I didn't get a question out of you, it would be unfair.
I normally threaten to ask a really boring question to encourage investors to ask questions, but maybe can I ask you both, or in fact all three of you, how you're thinking about long-term demographics in your catchment areas, and what are some of the left field things that might influence that? We see potentially declining birth rates in some emerging markets nowadays, and there are you know, changes for passengers per vehicle that might come through, and all kinds of technological developments that we keep an eye on. So yeah, just thoughts generally.
Who goes first?
I'll give you time to think, because my next question was going to be on technology, so I'll just steal that. One of the things I'm quite excited about is autonomous vehicles. I know you've done some work on this, Rob, but I think that you know, in the not too distant future, when you have autonomous vehicles, you can add a significant amount of capacity to roads because we can more efficiently use them with a more free-flowing traffic. I think you're going to create more trips rather than parking your car in the city. You're going to send it back home again. So potentially, you know, up to double the number of trips that we create. And I think the technology is going to be fascinating with all that downtime in the car. Like, so you've got an autonomous vehicle, you can do that 1 hour commute and actually be really productive in that 1 hour, whether it's video conferencing in the car, TikTok dancing, or watching Netflix, or, you know, whatever interests you. I think productivity has the potential to go through the roof as well. So more traffic, more productivity, you know, should be good for toll roads on a, I don't know, autonomous vehicles, 10 to 20 year view.
Yeah, we could talk about that. I mean, just to try and answer demographics. Well, we really want to go to areas that have some sort of assured growth, and demographics usually are taken care by immigration. That is usually qualified immigration, right? So when you look into Toronto, Dallas, Fort Worth, those areas have very diversified economies, and they even have new businesses that were not present in the area redeploying there. I mean, you have now less of a globalization perspective, so some key industries are being kind of relocated. So we have, I mean, not major, but some sort of investment there. So it's important to choose areas that keep growing because business and demographics go together. It's not birth rate, it's immigration, but I mean, these areas are fine. And regarding technology, I honestly not sure how the autonomous vehicle will play out, because if it's cheaper, because it should be, I mean, you don't have a driver to pay, but I mean, you're substituting public transit by cars, right? So any given bus, I mean, it's at least 10 cars, right? So the amounts of cars in the road is not fewer, right? And also with work from home, I mean, you wouldn't choose to be in a car just to be working out of the car on your own. Probably you do that from home, and if you take a car, it's because you need to be somewhere at a given time. And then, I mean, just certainty of time and delivery is important. Tours could play a role there as well, right? So technology is going to be very different depending on the area. There's going to be digital stuff and so on. But in the growing areas, I don't see less cars.
Yeah, and I've got some thoughts on autonomous vehicles, but the demographic question, I go sort of where Ernesto is going there in terms of, we obviously look at demographic characteristics very carefully in the markets we go into. It's important because it's the underlying sort of baseline growth driver that you look at. But then more importantly, you need to look at the specific corridors that the assets sit in, because that is it's actually more important ultimately in the growth characteristics you're going to see on a given concession. And you just need to look at Sydney and the different growth characteristics you see in the different concessions we have here to understand that. You know, look at what's happened to the M7 over the journey of us holding that concession, with the rise of that logistics corridor out there and the growth that's come off that concession. WestConnex, you know, there's a huge percentage of the Sydney population that's going to live within 5 kilometres of WestConnex in the years to come. So again, the corridor itself is as or more important than thinking about the whole of city demographics in terms of what growth characteristics we will get from our investment into the concession there. Do you want me to go to autonomous vehicles?
Go for it.
The interesting thing, I've looked quite closely at this. I've got a team, a strategic innovation team who works in the strategy team who've looked at this very closely, and we're doing some interesting things at the moment. And we found ourselves a little bit more in the middle of the conversation than you would have thought 2 or 3 years ago, because of some things that have changed around how people are seeing this. 2 or 3 years ago, you had the likes of Elon Musk and others saying that they were close to getting a kind of, you know, what was it, a disco car or whatever you were describing there, and that it was going to be solved in the vehicle and in the cloud. And now they're saying they're 5 years away, and they're clearly more, because the complexity of the edge cases is just inordinate here. In our models, we pushed out any assumptions we had around the application of autonomous vehicles out, not in. You know, so it used to be mid to late 2030s. It's into the 2040s now in terms of a more ubiquitous offering on the network around cars. But the flip side to that is commercial and freight applications of this technology have come in. And it's around the manageability of that, if that's a term. Point-to-point, high-value trips, moving containers from a port to an inland port on highly instrumented infrastructure, which can then manage the educations much more carefully and effectively, and that's us. So we went from being on the edges of the conversation to the middle of the conversation, and we found that that's what's changed around our business. So some of you will have seen we ran an autonomous truck on CityLink in live traffic conditions late last year. That's a precursor to a real commercial conversation we're having with partners around whether there's a commercial application of this, and then what that commercial offering would look for us, or what would it look like for us. But it's real, and what we're finding is that people who previously wouldn't speak to us are knocking on our door now because they understand the importance of the infrastructure in the kind of near to medium term application of this technology around freight as well.
Just to follow on, what's the CapEx expected to basically digitalize the road? Because the coverage that you would have to do on the roads is enormous, and it's an enormous spend. Or do you outsource that to a Telstra or a Vodafone or somebody else?
You mean in terms of if we wanted to run autonomous?
Yes.
Or we ran autonomous vehicles on our network. We've already got very highly instrumented infrastructure. I mean, CityLink would be one of the most sophisticated roads on the planet. and it would have some of the highest instrumentation that you will find. But it's a combination of data sources coming in. So we've got 600 CCTV cameras. That data was feeding through into the cab of the truck in terms of the autonomous vehicle platform that had been developed by a Taiwanese group that we were partnered with. That was one of the data feeds. So it was tied into our operations control center. We call it the OMCS. That data feed was coming into the cab of the truck as well. There are data sensors on the road that are feeding through. And then there's effectively, and this is where it starts, the new piece comes in the digital mapping of the infrastructure. So we had a dynamic digital twin, effectively, I assume everyone knows what a digital twin is, but it was mapped in a dynamic fashion so that it could track cars that were moving to allow the vehicle to merge in and out onto the infrastructure. That was something that we applied on the network. I wouldn't give you a number in terms of what the investment is, but we're much closer than people think based on current infrastructure, which is why then people are coming to us and why the routes become interesting.
I think most of the technology sits inside the autonomous vehicle. The investment, the infrastructure will have to make is being able to talk to the vehicle and tell them that, 100 metres ahead or a kilometre ahead, there's a congestion point or an incident.
Yeah, but I agree that right now, I mean, it sounds prohibitive, and probably the key would be that fiber is more present along the road, because sensors, there will be a lot of sensors, but you need also to process them pretty quickly. So the key is to have fiber all around any sort of lighting or whatever, and that is what gives you the more of the instantaneous reaction that you need, right? Otherwise, it's so many sensors around. So now it seems high, but it will come down very quickly. That's our view, and the key is more fiber deployed along the roads.
Another question?
Thank you. Yeah, one of the obvious differences between your two companies is construction, and so I'd really like to hear you both go toe to toe on why, say in the case of Ferrovial, why you need to own a construction arm, and in the case of Transurban, why you don't. And Pete, maybe you can be the adjudicator as to who wins.
You go first. No. We are not supposed to argue. I mean, both models could work, by the way.
We're just different, right?
It's different. Well, I guess I can start. For us, construction plays two roles. One of them is design, and there's a lot of, the opportunities that we get are because there's a lot of engineering behind it that is quite expensive, and you would say, and it comes to public bidding, yeah, but we at least have a head start on how things could cost, and we are able to develop the opportunity, otherwise it wouldn't be there. And then it steps ahead for delivery that we think is important. It's true that we suffer volatility from the P&L. It's a very complex business for the low margin it gets, but that's something that just evolves with contracts being more balanced. So you suffer probably when other contractors are suffering, and that gives you the axe to get infrastructure when things are sour. So we think it works, but it's a headache sometimes. But we think we can have an axe there. And as I said, delivery is very important when you are seeing repeat business with the same client, and that's how it works for us.
Yeah, and my answer would be, we're a 70 to 80% EBITDA margin business that's driving a very clear proposition that people can see and understand. And so we don't deal with the volatility that Ernesto is describing there at all. Running a very finely calibrated construction business is a totally different risk-reward paradigm. And it's not to say it can't be a good business in the right kind of market environment with the right people leading it, but it's a very, very different business. to the one we're managing. So we've got quite a focused proposition around the owner-operatorship of the infrastructure itself and what we can do with that, and then what we're driving towards, the kind of returns we're driving towards there that people, I think, can readily get their heads around. If we were to introduce, I mean, it's not in our sort of expertise. Having said that, the kind of networked model we run, because we do rely very heavily on the tier one contracting sector to deliver these projects, it's gone through challenges. We all know that, and there's a limited number of players in this country who can actually deliver the kinds of multi-billion-dollar projects that we have generally gone after. But again, it comes back to, I think, a question Peter asked earlier, which is then there are things that we can do to address it, and we think we're doing them, and we're quite comfortable with where we sit in the risk spectrum at the moment. If we had another multi-billion-dollar project emerge, we would have to think very carefully about how we moved, who we moved with, and under what risk arrangements we did. But I think we would still see that as very manageable.
I'm going to say, on principle, we want to own, as infrastructure investors, we want to own concessions. We want to own toll roads, not construction companies. That said, I think a pure outsourcing model can be dangerous. And I think even Transurban would acknowledge, and given the teams that you've built up, how many in your project execution team these days?
We've well in excess of 100.
Yeah. So 5-10 years ago, that would have been 20 people. Like you need people like Terry Chapman and others to navigate, big complex projects, and having that expertise, having some level of expertise in-house, I think avoids, some big challenges down the track. So is that a nice way of saying somewhere in the middle?
But by both steps.
By both, yeah. All right, I'm going to call it. Yeah, cool. Thanks everybody for your time.
Thank you guys for
Ernesto.
having us. Thank you.